So I'm going to talk about small cap stocks. What are they and why to invest in them? We've been hammering on this study that came out in the last year and a half from Jenga Capital Partners. Why? Because it aligns with the way we have looked at the market, and one of the reasons why we look at small cap stocks, but not specifically just small cap stocks, profitable small cap stocks. The stats from that report were that 87% of stocks that have jumped over 10x or 1,000% over the past 10 years began as smaller microcap companies, and 82% of those were profitable at the start of their ascent, where they started going up. 91% of those had some history of profitability. So if you're searching to find the next 10x stock, the key is small, growing, profitable, and undiscovered. But we talk about small cap stocks all the time. Why don't we define them first in terms of the way the market defines them, and then we'll define them quickly in our research and why potentially small cap stocks have that outperformance. So let's look at defining what small cap stocks are. Well, when I say cap, I just mean market capitalization, a measurement of company's size, total value of company's outstanding shares of the stock, or stock price times shares outstanding. Now, there's US market tiers that we look at here. The mega cap stocks, these didn't even exist a decade ago, but stocks with a market capitalization or market value of over 200 billion would be considered a mega cap stock. So the Alphabets, the Apples, the Microsofts of the world. Large cap, market value between 10 billion and 200 billion. Mid cap is market cap between 2 billion and 10 billion. And small cap is market cap between 250 million and 2 billion in the US. And these figures are in US dollars. And then we're looking at the micro cap to be anywhere essentially under 250 million in the US market. Let's look at those tiers in the Canadian market. We don't have mega caps essentially in the Canadian market, just large caps, market value of above 10 billion typically. Mid cap market value between 1 billion and 10 billion. Again, these are in Canadian dollars. Small cap is typically between 150 million and 1 billion. And then the micro cap is typically less than 150 million. Now, in terms of our coverage universe, let's take a look at a couple tiers here that we look at. When we are covering Canadian small caps, that's micro all the way up to mid, the market value is between right down to a company that might have a $5 million market cap if it had some liquidity, and up to about a 2.5 billion. So when we're in the small cap sector, we're roughly looking at 2,200 stocks that we are drawing from. And then we look at the profitable companies from that sector. We're monitoring all of them, but that's typically what we're looking at, that many stocks to monitor. US small cap coverage. This is coming soon. We're going micro all the way up to mid. Market value between 5 million, right down to the smallest of the small, right up to say 10 billion, roughly. That's roughly 10,000 individual stocks. We'll narrow it down to profitability in those companies, but we are monitoring those companies for when they transform themselves into profitability. So now you've seen that outperformance. I quoted those 10x stocks, more of them coming from the small and micro cap sector. Why the outperformance? Now, while the data shows, again, that small cap stocks do outperform, in particular, are the arena where you can find potential 10x stocks. But there's no silver bullet as to why the outperformance. Here are some of the top reasons that I can go through. Higher growth rates or prospects. Due to their size alone, small caps typically have higher growth rates than larger companies. It's not always the case, but it's easier at a basic level to double earnings from, say, $1 million to $2 million than it is to double earnings from $1 billion to $2 billion. So kind of just the law of large numbers there. However, the market often underprices small caps relative to similar larger companies. This means investors are typically getting better value for their investment dollar with the type of small cap companies that we recommend through our research service due to their potential growth, which is often not fully recognized by the market because of their lack of analyst coverage. So again, other reasons for the outperformance, that we just touched on it, that lack of coverage, it creates a greater chance of finding a mispriced stock. In many cases, Keystone is often, when we discover a stock, a small cap company, micro cap company, we're the initial research or the only official independent coverage on a stock, and almost always, like I said, the only independent analyst covering a stock. Compare this to the, even hundreds to at times thousands of analysts analyzing or following large cap stocks. You can immediately see why the potential to find an undervalued or under discovered, under followed gem is far more likely in the small cap segment of the market. This is one of the primary reasons why we apply our fundamental research to this area of the market, where we can truly add value and find the best growth and value stocks for you. Now, additionally, big players and some funds are restricted or just unable to buy at the micro to small cap level. Uh, like Buffett has said, he likes to play in that area, but he can't play in that sandbox anymore because he's just too large. You would have an advantage here buying smaller companies. You can buy before the institutions and often end up selling to them in the future. That kind of flips the old axiom on its edge. Let's look at other reasons why there's outperformance. It kind of goes deeper. I'm going to let you in on a little secret. Banks often act in their own interest. The financial industry is most often, like I said, acting in their own interest, not yours. Individual clients not acting in their interest. Their biggest clients are big companies. This is the primary reason doing financing for those companies that you can see a lack of interest in this sector from larger institutions. Small caps are generally less covered than mid to large cap companies. The banks or boutique brokerages, those that raise capital for public companies, they see more money in funding large cap stocks. Why not take commission on raising 500 million or a billion for a large cap versus 5 or 10 million for a small cap? This equals less coverage. Less coverage equals less knowledge of the stock, which creates the opportunity for a mispriced security or stock. Now, additionally, because the big banks keep getting bigger, they are historically less interested, like we said, in small caps in general. At this end of the market, it's been dominated by kind of boutique or mid-sized brokerages, which is an area of the market that has been shrinking considerably through consolidation over the past several decades. So the total number of analysts is shrinking, again, leading to less coverage and the chance to find that mispriced stock. We will note great growth stocks do not stay mispriced forever. For example, companies like Hammond Power and Expel, which came from our research, had literally no bank coverage or brokerage coverage, period, when we put out our initial buys on the stocks. Let's look here. This is the initial report on Expel, another company, no coverage, $1.42, not long ago in 2017. Again, our update on the stock here. Now, the stock trades no coverage at this point. It now trades at over $46, up 3,200%. The stock did not ever receive any coverage, big bank coverage in Canada. It is now graduated to the NASDAQ. Boyd had basically no coverage on this original recommendation at $2.30. Often profitable small caps receive the least coverage. Again, and I keep harping on this, this is our best opportunity to find those potential 10x stocks. It's just the big banks being the big banks. I encourage you to follow the money. The more profitable a small cap is, actually, the less likely it is to need capital. If it does not need to raise capital, the big banks and often even the shrinking brokerages, those boutique brokerages, will not cover these companies until they are far too hard to ignore. Again, these are great opportunities and opportunities that continue today. I'm going to give you an example of one. How about a recent example? This is 1 year ago, virtually to this date. We issued a focus buy on this company, Cipher Pharmaceuticals. There was no coverage on the stock. There had been in the past, but it was abandoned. In fact, the last brokerage report on the stock called for a significant decline in the core business, something that has not yet happened. Cipher was recommended at $3.89, bought for under 5 times earnings. 50% of its market cap was in cash and no debt. It says right there it trades at $16.90. I think it's moved up to around $18. It's literally the best performing stock on the Toronto Stock Exchange over that period, about 52 weeks. So why was it not covered extensively? Again, like I said, the balance sheet was great, roughly 50 million in cash with a cash flowing business, no need to issue stock, so no money in it for the big banks, and a great opportunity to find a mispriced stock. And it could become the next 10x stock. It's up already over 340 plus percent in 1 year. It serves to illustrate my point on where you can find these great companies. All right.
Yeah.
Thank you. And
Um,
then
yeah,
we
just
can
one
move
thing
on.
that I would say is, I mean, you already kind of like stated it in your section there, your segment, but I mean, Warren Buffett, like during his 1999 Berkshire Hathaway meeting, he was asked a question from the crowd. If you had to start all over again with $10,000, how would you go forward? And he basically said he would start by going through companies that started with the letter A and go through to the Z's. So going through every single company. And he says, I would start going right through companies and probably smaller companies because I would be working with smaller sums and there's more chance that something is overlooked in that arena. So, I mean, again, it's just exactly, summing up what you said there, but coming right from Warren Buffett's mouth himself.
It's a
It is in
good
some
quote.
ways the best and maybe the only competitive advantage that an individual retail investor has over an institutional investor. I mean, they
Mhm.
don't have the technology, they don't have the resources, but you're more nimble with your capital because you're investing smaller sums, and those institutions, they'll have a minimum investment amount to make anything worthwhile. And in some cases that's just too much for these smaller companies, but these smaller companies can grow into larger companies, and one day those institutions buy in, as Ryan just went through. But it's really the only competitive advantage that a retail investor has. Now, the flip side to that is that it's still, if you look at the entire small cap market or the entire micro cap market, the vast majority of the companies are not investment grade. So it's you have the advantage of being able to invest in these great little companies, but it takes a lot of research in order to separate which will be the potential winners or the higher probability winners from the ones that are just speculation.
Yeah, for sure. And that's why we give a base of profitability to just to as a starting point. And again, we've been harping over this for the last several weeks and in our 10x webinars. There's this old axiom that once a company becomes profitable, you've missed out on the gains. But again, I quote that stat over and over again. You're actually far better off to wait or have a company that has been profitable or is profitable if you're actually looking for those tremendous long-term gains. And that's not just me talking from experience. Again, that is the data talking. And then I like to use the data rather than just our experiences. Our experiences will tell us that too, but the data is very hard to ignore.